Loci. Identify characteristics, advantages, and disadvantages of organizational structures. A simple structure is centralized and typical of small firms, offering flexibility and quick decisions but limited scalability. A functional structure groups employees by specialization, promoting efficiency and expertise, though it may create silos and hinder cross-functional coordination. A divisional or SBU structure organizes around products, markets, or regions, improving accountability and responsiveness but potentially duplicating resources and increasing costs. Matrix structure combines functional and divisional reporting lines, enhancing collaboration but risking role ambiguity and conflict. A network structure outsources many functions, increasing flexibility and cost efficiency but raising dependency and coordination risks. Csca. Recommend appropriate organizational structures. Startups and small firms often benefit from a simple or functional structure, which provides clarity and cost efficiency during early growth stages. As organizations expand geographically or diversify products, a divisional structure improves responsiveness and accountability. Firms operating in dynamic, innovation-driven environments may adopt matrix structures to foster collaboration across product and functional lines, despite complexity challenges. Organizations pursuing cost leadership may prefer centralized, tightly controlled structures, while differentiation strategies often require decentralized, flexible arrangements. Environmental uncertainty, strategic priorities, growth stage, and competitive intensity all influence the optimal structural choice. Ethical decision-making. Csca. Identify and explain ethical issues in strategic management. Ethical issues in strategic management arise when leaders prioritize short-term gains over integrity and long-term sustainability. Examples include manipulation of financial information to meet earnings targets, concealing product quality or safety defects, and intentionally misleading stakeholders. Such behavior may temporarily inflate performance but erodes trust and exposes the organization to legal, reputational, and financial damage. Self-enrichment at the company's expense, such as excessive executive compensation, insider trading, or misuse of corporate assets, reflects agency conflicts and weak governance. Anti-competitive practices, including price fixing or market allocation, violate legal standards and undermine fair competition. Additional ethical concerns include exploitation of employees, fraud, corruption, and deliberate environmental harm. These actions damage stakeholder relationships and threaten long-term viability. Csca. Discuss corporate responsibility and the importance of a code of conduct. Corporate responsibility refers to an organization's obligation to operate ethically, comply with laws, and consider the broader impact of its decisions on stakeholders, including employees, customers, communities, and the environment. Ethical conduct supports sustainable value creation and protects reputation and brand equity. Formal code of conduct establishes clear behavioral expectations, articulates core values, and provides guidance for handling ethical dilemmas. It promotes consistency in decision-making and reduces ambiguity across diverse functions and geographies. An effective code also outlines reporting mechanisms, whistleblower protections, and consequences for violations. By reinforcing accountability and transparency, it strengthens governance and fosters a culture of integrity aligned with strategic objectives. Csca. Explain the role of tone at the top in shaping ethics. Tone at the top refers to the ethical climate established by senior leadership, particularly the board and executive management. Leaders influence organizational behavior through their actions, communication, and enforcement of policies. Employees observe whether leaders model integrity or tolerate unethical shortcuts. When executives demonstrate honesty, transparency, and accountability, they reinforce ethical norms and encourage employees to act responsibly. Conversely, inconsistent messaging or tolerance of misconduct signals that results matter more than principles. Ethical leadership includes clear communication of expectations, visible adherence to policies, consistent disciplinary action for violations, and alignment of incentives with ethical performance. Strong tone at the top promotes trust, reduces misconduct risk, and supports sustainable strategic execution. Csca. Discuss challenges in applying ethical standards internationally. Applying ethical standards internationally is challenging due to cultural, legal, and economic differences across countries. Practices considered acceptable in one jurisdiction, such as facilitation payments or gift-giving, may conflict with home country laws or corporate values. Multinational organizations must balance respect for local customs with adherence to global ethical standards and regulations such as anti-bribery laws. Inconsistent enforcement across regions can undermine credibility and create reputational risk. Companies face dilemmas involving labor standards, environmental protection, corruption, and human rights. Establishing global policies, conducting training, monitoring compliance, and maintaining strong oversight help ensure ethical consistency while navigating cross-border complexities. LOSO. Apply the IMA Statement of Ethical Professional Practice. The IMA Statement of Ethical Professional Practice is built on 4 core standards: competence, confidentiality, integrity, and credibility. When evaluating a business scenario, candidates must identify which standard is implicated. For example, manipulating financial forecasts may violate integrity and credibility, while failure to disclose relevant information could breach competence and credibility. The framework provides structured guidance for assessing ethical risks in accounting and strategic decision-making. Competence requires maintaining professional expertise and providing accurate, complete analysis. Confidentiality mandates protecting sensitive information unless disclosure is legally required. Integrity prohibits conflicts of interest and unethical conduct, while credibility requires fair and objective communication. The statement also outlines a resolution process. Discuss concerns with a supervisor, escalate internally if unresolved, seek confidential guidance, e.g., IMA Ethics Helpline, and consider legal counsel if necessary. Applying the framework ensures systematic ethical evaluation and professional accountability. LOSP. Apply the U.S. Foreign Corrupt Practices Act, FCPA. The Foreign Corrupt Practices Act, FCPA, prohibits U.S. companies and certain foreign issuers from offering, promising, or providing anything of value to foreign officials to obtain or retain business. Prohibited payments include cash, gifts, travel, entertainment, or other benefits intended to influence official actions. The law applies broadly, including indirect payments made through intermediaries or agents. The FCPA also contains accounting provisions, requiring companies to maintain accurate books and records and implement effective internal controls. Concealing bribes as consulting fees or miscellaneous expenses violates these requirements. When applying the FCPA to global scenarios, candidates must assess intent, identify whether the recipient qualifies as a foreign official, evaluate record-keeping accuracy, and determine whether internal controls were bypassed. Compliance failures can result in severe financial penalties and reputational damage.